September 2001. Imagine a newsroom somewhere in America, putting the finishing touches on a headline that would haunt a once promising company for years. The press had looked at the numbers and decided exactly how the story was going to end, and spoiler alert, it wasn't well. We're unpacking the brutal reality of that era today, because somewhere in Seattle, a man who quit a highly secure Wall Street career to sell books out of a rented garage was watching the very thing he built get written off as a complete punchline.
The term Amazon bomb wasn't just some fringe insult from a couple of cynical critics. It was the factual, consensus read on a company that was heavily bleeding money. This is the part of the history that most retellings skip right past because, honestly, it's a little uncomfortable. For a real stretch of time, betting against Amazon actually looked like the smart, rational position. The people saying it wouldn't make it weren't just cranks. They were looking at the exact same numbers everyone else was.
And those numbers? They were absolutely terrifying. Between December 1999 and September 2001, the stock had collapsed an astonishing 94%. We're talking about a plunge from over $107 a share all the way down to under $6. The dot-com crash didn't just put a dent in the company, it came incredibly close to burying it entirely. Analysts were openly speculating about bankruptcy.
Which brings us to the first part of our breakdown, the garage and the bet.
To understand how they actually survived that catastrophic drop, we have to rewind and look at the bet Jeff Bezos made in the first place. He left a highly coveted, super secure job at the quantitative hedge fund D.E. Shaw on Wall Street, literally the kind of job most people spend an entire career trying to land, just to draft a business plan in the passenger seat of a moving car heading across the country. In July 1994, the company was incorporated in Washington state, under the name Cadabra Incorporated. But that name didn't even survive first contact with a lawyer, who famously misheard it as cadaver. Definitely not the vibe you want for a new business, right? So he renamed it. By July 16, 1995, the site was officially open to the public, running entirely out of a rented house's garage in Bellevue, Washington.
Now, here's a fascinating detail. Books weren't chosen out of some romantic passion for reading or literature. They were chosen simply because the cold math made them the perfect wedge product to test an entirely unproven business model. Books offered an enormous catalog size and a very low unit cost. That made them the absolute ideal starting point to prove that selling online could actually work at scale.
The early investment really highlights the staggering human risk at the core of this whole operation. Bezos raised early capital from about 20 investors, but his own parents, Jackie and Mike Bezos, put up nearly $250,000, $245,573 to be exact. And Bezos didn't sugarcoat it. He told them up front there was a 70% chance they would lose every single penny. This was real money from real people who loved him, walking into the bet with their eyes wide open.
Okay, let's move on to the mechanics of survival.
How these companies actually survived the dot-com crash is a true masterclass in strategy, mostly because they weren't saved by some dramatic, heroic rescue during the crisis itself. Instead, survival came down to incredible timing. In January 1999, Chief Financial Officer Joy Covey raised $1.25 billion through a convertible bond offering, and she did this right before the market turned in December of that year. That decision, made in the calm season by someone paying close attention to a risk that hadn't materialized yet, secured the exact lifeline they would need to weather a 94% stock collapse.
But simply having the cash was only half the equation. When the storm hit, Bezos was ruthless. He aggressively cut costs, laying off 1,300 employees, which was 15% of the total workforce in 2001. He shut down projects with no realistic path to profitability and stripped away all distractions to focus purely on the core retail and logistics business, the thing that actually worked. It was not gentle, and it carried a real human cost.
That crisis forced the company to articulate the core engine of their business, the flywheel. It's this brilliant cycle of momentum. Think about it. Lower prices attract more customers. More customers draw on more third-party sellers. Those sellers widen the selection, which allows the company to push costs down even further. And the wheel just keeps turning. They paired this with a discipline of endlessly reinvesting operating cash straight back into infrastructure, treating every single day like day one.
So the crucial point of this era boils down to a single penny. In the fourth quarter of 2001, right in the teeth of the absolute worst downturn the industry had ever seen, the company posted its first ever profitable quarter. It was exactly 1 cent per share on over $1 billion in revenue. Now, a single penny sounds almost too small to matter, right?
But it wasn't. It was the complete, undeniable proof that the underlying model actually worked. Next up, we need to talk about the cost of scale.
To get the complete picture of this history, we have to look impartially at both the brilliant survival tactics and the heavy financial and human costs of building this immense infrastructure. During the dot-com boom, tens of millions were poured into outside ventures, names like Pets.com, Cosmo.com, and Living.com that completely collapsed. Bezos himself later openly admitted that these amounted to literally billions of dollars in failures. That's a founder acknowledging that a massive share of his capital allocation during that era was just flat out wrong.
And that reckoning hasn't just stayed in the past. Fast forward to a December 2024 U.S. Senate investigation, which brought sustained national scrutiny to the grueling conditions inside the company's massive warehouse network. The investigation accused the corporation of understating its own injury data, bringing serious questions about worker welfare straight to the forefront of national dialogue. According to those exact Senate findings, the warehouse injury rates were roughly 30% higher than the industry average. What this clearly demonstrates is that massive scale did not somehow erase operational problems. In fact, in many ways, the sheer size of the operation is exactly what elevated these issues into a national story rather than just a local one. The reality is, both the incredible wins and the serious harm exist side by side in this history.
Let's wrap up today with some plain truths for founders.
So, what are the core takeaways from all of this? First, you absolutely must be brutally honest about risk with the people backing you, just like Bezos was with his parents. Second, survival often depends on decisions made long before the crisis hits. Raise your cash in the calm. Third, cut your losses quickly on bets that aren't working instead of propping them up out of pride. Fourth, long-term thinking requires enduring years of mockery. And finally, never forget that success at scale does not excuse how the people building that success are treated along the way. Growth without responsibility carries a very heavy cost.
Nobody handed Jeff Bezos a guarantee back in 1994. He had a rented garage, a business plan sketched out on a car ride, and backers willing to face a 70% chance of losing it all. For years, the consensus was that they were dead on arrival. But that massive gap between what people are absolutely certain will fail and what actually happens when someone just keeps going is incredible. Since nobody has ever handed a guarantee when starting out, I want to leave you with this final provocative thought. If the odds were never the point, what are you waiting for?